Hi, I'm Beverly Harzog, host of Your Personal Economy. You can't control what goes on in the world in terms of inflation, but you can control your own personal economy. And I'm going to show you just how to do that because the way you spend your money is the way you spend your life. And I want you to have the best life possible. Thanks for joining me for episode number 28. We're going to talk about what happens if the Federal Reserve cuts interest rates. The Federal Reserve is having a meeting next week on September 17th and 18th. And there's speculation that there's going to be a cut to the interest rate. Now, the current interest rate is around 5.25 to 5.5%. And this is the result of 11 interest rate increases since March 2022. And the reason the Fed kept raising the rate was to tamper down inflation, which is just one of their tools to combat inflation. But unfortunately, that also makes interest rates on other things like credit cards and mortgages go up. So now we're looking at a possible rate decrease because inflation has slowed down. If it doesn't happen next week, I do predict it will happen before the end of the year. So I'm going to tell you what's going to happen when the interest rate gets cut and how you can prepare for that. So first, I'm going to talk about CDs and high yield savings accounts. You know, those places where we love to put our emergency funds because the rates are so high. You are going to see a whole flurry of excited media tell you to rush out and get a CD because interest rates on CDs are likely to go down. They've been really great because the interest rates set by the Federal Reserve have been so high. But I want to caution you about something. A CD may be a great investment for you. I mean, you can get them anywhere from 3 months to several years. Okay. And right now, I'm seeing rates 4 to 5%, a couple even at 6%. The one I saw was a 3 year rate. The problem with a CD, and if you don't have a healthy emergency fund, do not put your money in a CD. If you do have an emergency fund, all right, that is for an emergency. And that means it needs to be liquid. You need to have access to that money. If you tie it up into a CD, you don't get access until the amount of time has run its course on that. The term could be anywhere from 3 months to, like I said, several years. So that's a good investment for somebody who already has a healthy emergency fund and has money left over to invest. So if you fit into that category, it is a good time because those rates are going to come down. I talked about how on credit cards and mortgages, when the Fed raises the rates, those rates go up, which is not good because it makes borrowing more expensive. But it also makes it a good time to save money when the interest rate goes up. So you get a better rate on CDs and on those high yield savings accounts. Now, the high yield savings account is a different sort of thing from a CD. Rates are very good. I've been seeing rates anywhere from 4.25 to greater than 5%. And keep in mind, all of these rates change a lot no matter what the vehicle is. It could be CD, the high yield savings accounts, or credit cards. So you always need to check rates daily. I'm just giving you a snapshot so you can get an idea of the direction things might go in. Okay. But with the high yield savings accounts, you can't lock in that rate. Yeah, it's a good rate right now because the interest rates are high. So when the interest rate gets cut, that means it's going to go down a little bit. You're not going to see super high yields on these savings accounts anymore. That doesn't mean you should pull your money out. It's still going to probably be a great place to park that emergency fund because with a traditional bank, the interest rate on savings is very, very low, and that's just going to get lower. So sometimes you have to pick the best place to park your money depending on the economic conditions. Okay. And that's what we're coming up against here. So don't pull out your money from your high yield savings accounts. Don't rush out to buy a CD unless it works for you financially. All right, let's look at credit cards. Now, with credit cards, the APR they are so high right now. The average, according to Forbes Advisor, according to their weekly credit card rates report, is 27.64%. Now, let's do a little experiment here. Let's say the rate cut is around 0.5%. Okay. And I don't think it would be higher than that. It's probably going to be lower than that. But just for our purposes, let's say it's zero point 0.5. That means the average rate on a credit card will go down to 27.14%. Now, that's really not going to help you all that much, right? So, yes, it does make borrowing less expensive. It's less interest to pay on your debt, but it's still not good debt to have. It's still a super high rate. So, here's what I want you to do if you've got credit card debt. You don't really need to wait until the rate decreases because, like I said, it's not going to help you all that much. It's going in the right direction. Yay. Okay. But it's still not going to make a huge difference in what you have to pay back. You need to get rid of this debt. So I want you to work on your having a good credit score and see if you could get a balance transfer credit card where you can get a 0% APR anywhere from 12 months to about 21 months right now. That means you pay back your debt, you make monthly payments, and you make them on time, and you don't have to pay interest during the intro period. There's usually a transfer fee anywhere from 3 to 5%, but run the numbers, it might work out really well for you in the end, even with a transfer fee. Okay, another thing to consider, the rates on personal loans are going to get better. Okay, they're going to go down a little bit too. So if you can't get a balance transfer card, you might be able to get a personal loan or maybe even a debt consolidation loan. Now, they're not going to be terrific rates, but it could be much better than the rate you have on your credit card, even after the rate decrease. Okay. All right. Next, let's take a look at mortgages and student loans. How's a rate decrease going to impact your wallet? Okay, now let's look at mortgage rates. If the Fed cuts the interest rate next week, mortgage rates will go down. Now, it's not directly tied to the federal funds rate, which is the rate that the Fed decreases, but it follows it closely. So as that rate goes down, so do mortgage rates. Credit cards are directly tied to that because they're directly tied to the prime rate, but mortgages are a little bit different. But if you see a rate decrease next week or sometime this year, you can see that you can see that mortgage rates will go down a little bit. So that's the good news. The not so great news is that that also will increase demand because borrowing is now less expensive. So demand will rise, which can also mean housing prices might go up again. You fix one thing and then something else pops up. It can be tough in this economy, trying to catch when to buy a house or when to sell a house at just the right time, but you just do the best you can. And it is going to get a little better for those buying. I think even with housing prices going up a little bit, it still could make mortgages more affordable. Be sure you've got a great credit score because you're going to need a great credit score to get the best rates, the best low rates. Okay. Now, one thing you can consider if the rates go down is refinancing. If you've got a rate, let's say you've got a 7.5% mortgage rate. Okay, well, I feel for you because I know that's expensive. If the rates start to go down, you might consider refinancing at some point. Right now, the 30-year refinancing rate averages at 6.4%, 15-year averaging at 5.79%. And so those will go down a little bit too. So that's something to consider if you really like your house, but you're having trouble, making the monthly payments because of your mortgage rate. So keep that in mind. And it's also something you can keep in mind for student loans. Now, if you've got private loans, you can consider refinancing that once rates get a little bit lower. And just look at the rates you have and see what makes sense for you. If it looks like the rates, when you start comparing them with different lenders, if it looks like they're lower than what you have, then start thinking about that. We really don't know what's going to happen with all the student loans you have, if some will be forgiven or not. So just continue paying your student loans. It helps you build credit. Okay, there's the silver lining. And if anything happens and you don't have to pay all of it back, well, just consider that a happy surprise if and when that happens. But do consider refinancing with private. Now, with federal, you would lose your benefits if you did that. So that's not really an option when it comes to refinancing. Thank you so much for joining me for episode number 28. We talked about what will happen if the Federal Reserve changes the interest rate next week, particularly if it's a decrease, which is what we're all expecting. It may not happen next week, but if it doesn't, it will probably happen before the end of this year. Now, coming up next, I have a real treat for you. I have a special guest, Patrina Dixon, the owner of It's My Money. And she and I have been friends for a long time, and she is one of my favorite personal finance experts. And we have a fabulous money chat. We talk about spending and savings tips, and we also talk about how to talk about money with your older kids. So be sure you check out episode 29. Thanks for joining me today. And if you're enjoying my podcast, please subscribe. I'm here on YouTube and also on Spotify and on Apple Podcasts. Thanks for joining me.